A dividend snowball is most likely a concept you've heard about. Today I want to discuss the greatest dividend snowball, focusing on the present rather than the past. More specifically, I intend to discover if there are ideal dividend characteristics to go for to optimize the advantages of a dividend snowball. I took several price appreciation ranges, dividend yields, and dividend growth into consideration. When choosing equities to invest in or creating a dividend portfolio, these three elements are largely under your control. And in this video, we will be answering what is the best dividend snowball. So make sure to subscribe here on Usable Wisdom and hit the notification bell. It's completely free and you may change your mind at any time. That way, you'll be the first to know when we share new money-making ideas. So it's a win-win situation. Without further ado, let's proceed to the topic. I want to emphasize the phrase, relativity within your control, because while you can aim for a particular dividend yield when you begin investing, it can be difficult to sustain it over time. Likewise, with dividend growth, there are no assurances that previous dividend growth rates will endure in the future, but you can pick stocks whose dividends have historically increased at a certain rate. I'll assume for this demonstration that we were successful in obtaining the required level of yield, dividend growth, and capital appreciation for a given amount of time. And the dividend snowball truly depends most on the passage of time. Let's start with a window of time that is only 5 years long, and then we'll move out 5 years at a time after that. All scenarios presuppose that each's portfolio receives a yearly investment of $6,000. For those under the age of 50, this is the current maximum Roth IRA contribution limit. We can avoid the cost of taxation on the results by using this annual contribution amount and a Roth IRA portfolio. So, after 5 years, the 1% dividend portfolio with the greatest rate of capital growth and dividend growth would have the highest market value. With or without dividend reinvestment, the market value would be around $37,500 and $38,500 respectively. Between the remaining higher-yielding portfolios and the 1% dividend yield portfolio, there isn't much of a difference. As we increase the dividend yield, each higher dividend yield portfolio's market value will decrease by a few $100s. With the 5% dividend yield portfolio having the lowest market value at roughly $31,000 without dividend reinvestment, or about $34,500 with dividend reinvestment. To examine if the outcomes alter, let's extend the time frame to 10 years. With the final market value of just over $100,000 and dividend reinvestment contributing 5.9% to the overall market value increase after 10 years, the 1% portfolio once more generates the highest market value. The market value of the 2% portfolio is approximately $10,000 less than the 1% portfolio, or around $6,000 less after dividend reinvestment. As we increase the dividend yield from 1% to 2%, the advantage of dividend reinvestment nearly doubled. With dividend reinvestment, the market value of the 3% portfolio is likewise roughly $6,000 lower than the 2% portfolio and about $10,000 lower overall. As we climb the dividend yield ladder, this cycle is repeated, with the 5% portfolio's market value being roughly $66,500 without dividend reinvestment and $84,500 with it. Therefore, if you had the 1% dividend yield portfolio instead of the 5% dividend yield portfolio after 10 years, you would have between $20,000 and $40,000 more in market value. In year 10, the 1% portfolio would produce $1,449 in dividends, while the 5% portfolio would produce $4,520. As a result, the 5% portfolio's dividend income was roughly 3 times greater than that of the 1% portfolio. However, the total dividends paid in year 10 for the 4% portfolio are $4,107, which is just a little less than the 5% portfolio. In reality, over the course of the 5 years, there was a discrepancy of nearly 18% between the dividends received in year 5 between the 4 and 5% portfolios. However, this disparity narrows to barely 10% by year 10. Let's look ahead 15 years and see what transpires. The 1% portfolio surpasses $200,000 with and without dividend reinvestment after 15 years, whereas the 5% portfolio would have a market value of approximately $105,000 without dividend reinvestment or $157,000 with reinvestment. The two portfolios with the greatest dividend yields are starting to converge when looking at the overall amount of dividends received. The 5% portfolio would produce approximately $43,000 in dividends without dividend reinvestment, and approximately $56,000 with reinvestment, whereas the 4% portfolio would produce approximately $41,000 in dividends without dividend reinvestment and approximately $52,000 with reinvestment. The 3% and 4% portfolios still have a significant dividend yield difference of up to $8,000, depending on dividend reinvestment. Even wider, ranging from $7,000 to $10,000, is the difference between the 2% and 3% portfolios, and there is an $11,000 to $14,000 difference between the portfolios with 1% and 2% yield. Small dividend yields with rapid dividend growth cannot overtake investments with large dividend yields, not even after 15 years. Now, let's look ahead to 20 years to observe how these situations develop. Once more, the dividend yield portfolio with the highest or lowest market value. And given that faster capital appreciation is the primary stimulus here, this pattern will last for a quite considerably longer time. The 1% and 5% portfolio's market value differences after 20 years are roughly 77%. Therefore, even though it hasn't nearly doubled yet, the lower yielding portfolio would grow in total value at a rate that is about 3/4 greater with dividend reinvestment. The 4% portfolio outperforms the 5% portfolio in terms of total dividends received by about $2,000 when dividends are not reinvested. The 5% portfolio still outperforms the 4% portfolio with dividend reinvestment, generating around $1,500 more in dividend income. The year 20 sees an intriguing event. The portfolio paying out $16,460 in year 20 at 4% was the best. But with $16,314 paid in year 20, the 3% portfolio also outperformed the 5% portfolio. The deficit isn't really that close now because the 5% portfolio would only generate $15,232. In fact, not only has the 3% portfolio outperformed the 5% portfolio, but it is also very nearly catching up to the 4% portfolio. With $14,022 in dividend payments made in year 20, the 2% portfolio has also grown significantly. Between 15 and 20 years, the difference between the 2% and 5% portfolio in terms of dividends paid in the last year has shrunk dramatically, from roughly 39% to about 8.5%. Oh, and before we continue, we would love to hear your own experiences while navigating through the world of dividend investing. And what valuable lessons have you learned so far? Feel free to comment below. Once you're done, let's continue. When we fast forward 25 years, the same pattern still exists. Market value remains the most stable factor. Although lower yielding portfolios with faster capital growth have seen a rise in the level of dividends they create, with the 3 and 4% portfolios producing the most of them. The 3% portfolio has now overtaken the 4% portfolio in terms of dividends produced in the last year, while the 2% portfolio has now surpassed the 5% portfolio. It provides an additional dividend of around $5,000 in year 25. Therefore, aiming for a dividend yield that is closer to 3% may be the best course of action if your time frame is 25 years. Adding 5 more years to the present to reach year 30. With dividend reinvestment, the 1 to 3% portfolios have now increased to more than $1 million. The market value of the 4% portfolio is close to $918,000, while that of the 5% portfolio is only $670,000. The 5% portfolio would have produced the least amount of dividends without dividend reinvestment. With dividend reinvestment, the 5% portfolio still outperforms the 1% portfolio but falls short of the 2, 3, and 4% portfolios. Moving forward, the market value of the 1% portfolio nearly doubled with dividend reinvestment, going from $1.7 million to $3.4 million after a 5-year jump to a 35-year timetable. In reality, the 2 and 3% portfolios would both now have market values above $2 million, with 4 and 5% portfolios exceeding $1 million. With reinvestment, the 3% portfolio would still have produced the highest dividend income, with dividends now exceeding $1 million. In year 35, the 2% portfolio would produce the most dividends, a little over $145,000 in tax-free dividend income. Another intriguing development is that the dividends generated in your 35s for the 1% portfolio are higher than the 5% portfolio and the 4% portfolio. Thus, 35 years of high dividend growth have now paid off. It is challenging to maintain significant dividend growth over 35 years though. In case any 20-year-olds are watching this, let's take a peek at a 40-year time horizon. The market value of the 1% portfolio doubles once more to around $6.8 million after 40 years. Similarly, the market values of the 2%, 3%, 4%, 5%, and 6% portfolios are approximately $5.7 million, $4.1 million, $2.7 million, and $1.6 million respectively. The 5% and 1% portfolios differ significantly. All 5 scenarios would now have produced more than $1 million in dividends during this 40-year time frame with dividend reinvestment. These cases were all carried out under predetermined circumstances, making it almost unfeasible to employ the same approach. You'll probably switch between several dividend yields and dividend growth levels during your dividend snowball pursuit. But I do want to wish you well on your travels, and keep in mind that the secret to succeeding with dividend investments is perseverance and discipline. Thanks for watching. I hope this video helped teach you something new. And if you enjoyed this video, please subscribe and click the notification bell for more content like this. Until the next one, bye!